Hi everyone, my name's PK and I'm so grateful today to have Kent Lardner on with me. And this is going to be a really cool episode, something we haven't really done for a while. When everyone talks data, they generally talk data with the intention of trying to sell you something like a property or something like that. The reason I have Kent on is that I saw him on LinkedIn. I was like, who's this guy sharing all of this amazing information with no agenda? All right, no agenda whatsoever except data for data's sake. So this is going to be a phenomenal episode, hopefully. Kent, thank you so much for making time.
Oh, PK, thank you for the invite. Yeah, I think it was more a bit of a Gary V inspired thing to, give stuff away and then it comes back at you. So I think that was a lot of my inspiration actually. I'm not as much of a sales hypey guy as him. I'd love to have a little bit more of that in my arsenal, but LinkedIn's been my main focus for some time. I was on Facebook and I effectively just stepped away from it. I just couldn't relate to some of the commentary and comments and whatnot. So LinkedIn's my domain, absolutely.
Amazing, amazing. Okay. So today, for everyone who's watching and listening, we'll go through, Kent will share, insights like where he sees the biggest rent rises at a high level across Australia, where he sees continued capital growth occurring for the next few years, but also where the downturn has started, but will be the shallowest, those types of areas. And then we'll also talk about some essential data factors that I think investors, and more important than me, Kent thinks that investors should have in their arsenal before investing in property. But before we get to all of that, Kent, it would be super amazing. I mean, I couldn't do it justice. So if you could just introduce your data background, I think you've worked for CoreLogic, for PriceFinder, all these household names. What's your sort of data background and why is data important in the first place?
Yeah, I started out. I was sponsored by a mortgage insurance company. Back then, it was called GE Mortgage Insurance, and at that time, they had a plan to migrate out of just focusing on lenders' mortgage insurance and moving into data analytics, automated valuation models, and some other risk products. So they sponsored me to go back to school and study, and also sent me to meet some very wise men in both Canada and the US who were experts in the domain. So they sponsored me, and I learned for a few years and ended up learning how to design and build AVMs and some risk models and whatnot. And at the time when we were ready to go, the G split that side of the business out and it became Genworth Financial. So all those plans were effectively turfed. And at that time, that's when Pricefinder knocked on my door, and we designed the interactive price finder estimates tool with those skills that GE so kindly helped develop. So I spent a few years with Pricefinder. We launched that back in those days. It was a lot of that stuff was new, and there was a fair bit of mystique around automated valuation models and the interactive model that we created. We sold that business to the Domain Group, and I moved over to CoreLogic, or back then RP Data. I was head of their analytics banking platform team, and I finished up my time there. The last stint I did at CoreLogic was about a year up in China, trying to set up the equivalent of an RP Data
Oh, that
in
sounds
China
cool.
with a partner, and it was so fascinating. You're in awe. I don't know if you've been to China, but it's the scale of it. It's just mind blowing. So it was an exciting time. So there was about a year I spent there, and then I came back to Australia. I took one small project. I redesigned a website called Real Estate View, and I'd never done anything like that before, and learned a little bit about what SEO was. I didn't even know what the acronym meant. So we designed a landing page for every property in the country, and got that from about 600,000 visitors a month up to about 2.7 million. So people were
Impressive.
searching for addresses and doing that a fair bit. And since then, I've just been running my own business called Suburb Trends, which is devoted to a whole range of property data and analytics functions.
Yeah. And I didn't send you this question before, but it just came to me now. So I hope you don't mind me asking. These days, I see someone like you who's a true, you could say, data connoisseur. You live and breathe data, not in like a superficial way, but for the sake of getting true insights. And then on the other side of the spectrum, all over advertisement, whether it's YouTube ads, Facebook ads, whatever, you have all these people that claim, and once again, I don't want to speak bad about anyone, but there's terms like data science or AI or machine learning in real estate that get thrown around very loosely. How do people understand when they think everyone is into data these days? Anyone who's selling a house and land package, getting a kickback from a developer.
Effectively, end to end is the data science piece where you're really doing everything from collecting it, understanding how it's collected, cleaning it, munging it, preparing it, and then modeling it. You need to, and the way you can model it, obviously, machine learning is a go-to for most people now, but you need to understand what that is, and then interpreting the output of it. I do a fair bit of machine learning with the models to do some predictions, specifically predicting sales volumes and listings volumes, and then combining those to come up with an inventory analysis. But more now, I'm moving on to a lot of rental analytics. So forecasting how many properties are going to be vacant over 21 days, vacant, etc., and then calculating a forecast vacancy rate. So to answer your question around the differences, it is abused. The term machine learning AI, people just throw it away and people go, ooh, that's impressive, and don't ask questions. And I think you'll find if you scratch the surface, most people wouldn't have an answer, and there's a bit of BS. I think a lot of companies love to use reference AI because it might add a little bit to their earnings multiple. So,
Well said.
I think we should be cynical, right?
Yeah.
The bottom line is I had a team of analytics, really well-paid, highly educated analytics people, and they were building models one by one, effectively regression model, linear, non-linear models, building models. And all really machine learning has done is given us the ability to replicate the productivity of those types of people 100 times over. What doesn't change is you still need to understand the data. You still need to be able to effectively prepare that data, optimize the inputs going into this, and then understand what comes out again. And if you don't have that domain knowledge, you really don't get much out of it. So I think that's a really important piece.
No, that's 100% correct. Just because you have a lot of data, that doesn't mean that you know how to use data. And when we talk about things like regression analysis, like multivariate regressions, normalizing for collinearity and autocorrelate, there's a lot that goes into it. And if you just ask the right questions, you very quickly realize who's actually knows what they're talking about versus who doesn't.
Exactly. And there's a lot of bad. Look, actually, that's an interesting thing. I was using machine learning models a lot up until about 6 months ago, and then everything started to turn. So you have to almost, given how much has changed in the last 6 months, you've got to start over again. And that's something I've learned is you've almost got to, if you thought you could set a standard model and walk away and come back in 2 or 3 years' time, you're really wrong, because everything's changed. All the rules are different. All the data is different. So there's a whole stack of new data variables that I'd love to talk about today that I'm now using that I didn't really focus on 6 months ago, but now they've opened up and there's a whole new, world of opportunities there. But what did happen is I was building models. We were all working with models with data going one way, prices going one way, inventory flat or going down. And it was pretty easy. They were fat and happy models, right?
Yeah.
And then everything changed.
Yeah.
Things started to turn. And right now we've got some oddball things going on where you've got prices going down at the same time as inventory going down. So there's some fascinating, conflicting things happening in the data world.
So maybe on those fat and happy, I think that was the term, right? Fat and happy models.
Fat and happy models.
I think they still probably exist for the rental market, because the rental market is still
Very
happy
stable.
and going along. So like, where do you see, I mean, everyone knows we're in a rental crisis, a chronic lack of rental properties almost in all of Australia. where is it the most acute? Where are these? I mean, it's a social problem, so we can't take away from the social issue, but for property investors, where can they get the highest rent raises or the best passive income increases over the short term?
Yeah, look, it is a crisis. Southeast Queensland is in a mess, and that contagion is spreading. So a couple of call outs that I'm observing is the correlation. You mentioned correlation earlier. Thank you. If you look at income versus rents, there's a very, very strong correlation there. So what that tells us is you can't ignore income. So you can't expect a linear growth in rents in an area where it detaches itself from income. People can't pay more than a certain percentage of their income on rents. So you've got to always keep that in mind that, whilst the model might work from here to here, it's not going to continue to grow in a linear manner. Expect people aren't going to borrow money to pay rent.
No.
Whereas in the mortgage space, they could borrow significant amounts of money. So the correlation was a lot less between income and house prices, but it was a fairly decent correlation between income and mortgages. And they'd borrow what they could. Same principle applies to rent. They'll pay what they can, but not a cent more. So I think that's the call out. Now, a couple of areas. So the areas that are standing out, the unit market, if I looked at unit markets, if you've heard me talk about a year ago, I really was a little bit negative on units. So I'd always kind of say, look at houses, because of the history. Units have not had as solid a capital growth over the long term, over the last 20 years compared to houses. But right now, units are looking very differently. So I'm letting the data speak. And when I do some scorecards and whatnot, the unit markets are actually really starting to bubble up and look quite solid. Now, so answering your question about where rents are going up, I've done a couple of things. I've looked at, well, where is the affordability ratio less than 30%? What I mean by that is, where are those markets? Where are those suburbs where people are spending less than 30% of their household income on rents? So that gives me a proxy for, is there room for growth in terms of rents? Then the other thing I've looked at is, well, where are vacancy rates still falling? Where are they critically low or falling? Then you've got the other factor is where they've been high and the prices have had to adjust to then drag people back in. And now we're coming off a very low base and those rents are rising. And you've got a combination. So you've got, and the example of that is Docklands and inner Melbourne, where vacancy rates were double digit for some time. And what happened is finally landlords put their pride on the shelf and adjusted their prices and people are coming back in. But because we're coming off such a low base, those vacancy rates are coming down and those rents are really surging. So put that to one side. By and large, what I've identified is markets that have got relatively low vacancy rates, but have come down a bit and have that affordability number, that ratio percentage that still looks good. So Brisbane units specifically in Southeast Queensland, Cairns, I'm looking at a list here, so I've just got the list behind the camera. Orange, Maitland and Perth. So I'm kind of broad, high-level stuff. So that's for the unit market. And now for houses, I'll kind of zoom out and talk at a regional level. Adelaide, the regions of Unley, Adelaide Hills, Playford and Port Adelaide. So they've all got, I believe, room to grow with their rents. Belconnen, Tuggeranong and North Canberra. Ballarat has got room for rental growth. Brisbane South, specifically that Carindale market. Maitland reappears again, but now in the housing space. Melbourne Northeast and Northwest houses, areas like Keilor, Yarra Ranges and Monash. And then to Sydney, the outer southwest, Blacktown, outer west and Blue Mountains, still some room to grow there for rents.
Right. I find that really interesting. I was an article is going to come out very, very shortly on realestate.com.au where I was also talking about the fact that house prices have gone up so much in Southeast Queensland. Everyone knows that, and Brisbane and other places like that. But there's still some townhouse type of dwelling types where they haven't gone up as much and there's plenty of room for them to to go up, and then when you correlate correlate that, or you sort of say, okay, well, what about the rental side of things? And you're saying that units or townhouses have a lot of potential there too. I just think that you can't say no to buying in Brisbane right now. It's about the right dwelling type in the right suburb, as opposed to, hey, this house has gone up 50%. We're past the boom. That
Yeah.
may be the case, but for units, it's not necessarily the case. And I personally, I don't want to put words in your mouth, but I personally don't mean go out and buy, units in Newstead or West End. The right type of dwelling is always very important. One question I had as a subset of that, Kent, is, this kind of 30% magical ceiling. Everyone kind of agrees, that 30% of incomes towards rent, that is sort of the affordability threshold. I think, right now across the board, we're somewhere like 22, 23%. I could be wrong. It's reached almost 30% before. That was many, many years ago, if I look at the ABS data correctly. Why is it 30%? I mean, times have changed.
Yeah, I think it's an arbitrary figure. I first uncovered it about 20 years ago in a report from Demographia, which is a global research done to look at affordability in both rental and mortgage space across effectively most of the globe. So that's where the 30%'s just been imprinted with me. So that's what I work to. So I don't know the original source of it, but
Right.
I'll attribute it to Demographia.
Sure. Because I know there's a precedence for around 30%, but when I look at other places around the globe, it's well beyond 30% and people are just paying rent. So it's just like, I like to question things. So I thought, let me ask that question. And then just like you had shared that list, what's your view on the best areas for capital growth in the next few years? I mean, not everywhere in Australia has boomed to the same degree. And maybe the flip side of that question too, those areas that have boomed and are now going down, much of Sydney, much of Melbourne, example, where is that boom going to be the shallowest, and where is the bottom of the market, the magical bottom of the market? When's that going to occur? Tough questions,
Yes.
Kent.
And that's, well, I think what we first thing to call out is it's markets. So, I like to look at an SA3 as a market, which is, the statistical area 3 used by the Australian Bureau of Statistics. So I don't like to look at a suburb as a market. I don't like to look at a city as a market. I like to look at an SA3 as a market. And then what we're even finding now is within SA3s, there's sub-market groups within that are starting to really behave differently, especially the top end.
Yeah.
A lot of the top end stuff, a lot of the owners are quite aware. They're smart, obviously. They're pulling properties off the market. If I don't have to sell now, I won't. Therefore, they pull it off the market. So the top end are seeing a decrease in the volume of listings and sales. And what that's doing is having this artificial bias towards the lower end, because the others aren't pulling back. So the stuff in the middle, the stuff at the lower end, effectively what that does is skew or create this compositional bias to drag your price down. So there's some interesting things happening at the moment. So that was probably the first call out. What I will do is just kind of maybe point to a little anecdotal story of what happened in the early 90s. So those who were around, or those of my age group and older, would know that the Victorian economy went through a really hard time in the early 90s. And then they had a change of government to a fellow by the name of Jeff Kennett. So what happened is the economy really went through some tough times. And what happened, if you look at the long-term trend line of price growth for the city of Melbourne and most of the suburbs and markets of Melbourne, they dipped. They dipped in the 90s according to the dip in the economy. And then what happened, it was just like a little dip that caught up to the long-term trend line as soon as the economy got back on track. And I think there's a lesson to be learned there. And I think, kudos to CoreLogic is they've always called out peak to trough. I don't know if you ever heard Tim reference it. And I don't think I ever truly appreciated when he said it. Now I do. And I think more than ever now I understand and value what he's always said, is that peak to trough is because I think what will happen is you now know what that market's capable of reaching. How fast could it, how elastic will it be? How fast could the market rise back to that long-term trend, just like it did in Melbourne in the 1990s. So I'm of the opinion that, and it's a bit of a trick with data here, because the question is where will we see the highest capital growth? Well, I would argue the markets that dip the furthest may well be the ones that sling back the fastest or sling back and give you the highest rise again. It's just a matter of how long. And then looking at some other fundamentals and not applying that as a general rule.
Yeah.
But I do think that will happen. So I think the first one will be watch for markets that have this almost a dip that is beyond reason. A significant, substantial dip that doesn't make much sense. And there could be emotions in it. It could be some forced sales, but I think a lot of people just panic. So I think look for the dips. That'll be another one. The other one I'll look at, I think the downsizer markets will be of interest. So you've got, even though, Sydney and Melbourne housing markets might come back 10, 20%, whatever that percentage is, there's a lot of boomers who own property that are very cashed up, and it doesn't matter that it's 10% down. It doesn't matter at all. So those people will take their wealth with them into the traditional retirement downsizer locations, and they'll spend that money. They'll spend it to keep their pension. That's still happening. There's still a big wave of boomers retiring. So I would argue that there's going to be a lot of these downsizer locations, retirement locations, that will still enjoy growth. They'll be influenced by what's happening, but the boomers aren't, because they're all cash buyers. They don't care about interest rates. So I think that was another one. And then I had the third note I made, the really big infrastructure projects, the stuff that got the world out of the Great Depression, the Hoover Dam stuff. Look for those types of big scale, dig us out of the hole type projects. I think the fast rail might be our Hoover Dam.
Right.
And that'll link up to my hometown of Newcastle. It'll go through Wyong and Gosford. So with that view of Sydney being, the six cities idea, what we might find is there could be then a very strong pegging or correlation between those markets. So it becomes one big Sydney market. And, if effectively we might find a place like Wyong that is, half the price of Sydney, that could really benefit from a train station, a fast train, 40 minutes to Sydney. And it could be just speculation. All you really need is speculative investment to drive that market, who are saying, yes, it could happen and probably will happen in 10 years' time.
Enough sentiment, becomes a self-fulfilling prophecy. One thing I just wanted to toy with you was, I think there is this sort of underlying, once again, sentiment that Sydney and Melbourne, but mostly Sydney, will always grow. It will always grow the fastest. It will always grow the most. And I think a lot of people, at least my audience, they sort of think that, yes, Sydney is going to drop. It's already dropped more than 5%. It will probably drop between 10 and 20%. I've been saying this for a long time as well. But then that is a really amazing time to buy. And of course, markets within markets. I'm just talking Sydney here.
Yes.
That is a really amazing time to buy. Call it next year or whatever it is. And then there's going to be like this amazing boom again. And it's almost like cryptocurrency, you buy the dip. I wanted to toy with that idea because I don't subscribe to it. I wasn't investing, around the Olympics, but we all know how well the property market did around the 2000s. And then, Sydney, I think from 2003 for the next, 8, 9, 10 years, it was basically flat. And everyone who thinks right now that, Sydney is always a boom town, back then they were probably thinking Sydney never grows, right? Like 2 years ago, I was having to convince people to consider Adelaide, and they were like, well, Adelaide never grows. So just kind of, what's your thoughts on, could we actually experience a bottom or a downturn, and then Sydney just languishes because of things like, incomes not keeping up with house prices, because of higher interest rates, because, Australia has the second highest debt to GDP. Could it be that until 2030, Sydney is just kind of lazy and that there are better opportunities elsewhere?
Yeah, it's interesting. If the money coming in to buy those properties is dependent on mortgage lending, we can't dismiss the impact that's going to have. We've come off a record long period of almost free money. So that's gone. And I don't see that ever coming back. So I think that's going to be the number one constraint, people's ability to borrow. So borrowing capacity will be the number one determinant of everything that goes on. Whereas if we look at what happened post Olympics, that was that long-term trend downwards. We came off very high interest rates, and that really kicked the boom up.
Yeah.
So it wasn't just the Olympics; it was the interest rate movement. So I that's the big standout argument for me. Sydney, it's a diverse, amazing place. I think it's going to be a rich person's playground if it's not already, and it'll appeal to a lot of people coming out of Hong Kong or China or whatnot. So there'll be markets that'll still benefit from those cashed up buyers without a doubt. But I don't think we're really talking about that, because we're really focused on we're not really looking at owner occupied millionaires. We're talking about investment grade type properties, that sub 750 stuff. I think the standout for me of Sydney is you can't buy a house for under 750K in Sydney, really. It's gone. So you're forced into a different asset class. And I've always said, I'm on record saying, look, really units are a different asset class, and it's a substandard asset class comparison to houses. But you mentioned, PK, earlier on townhomes. And, one of the things I thought 2022 would be the year of the townhome.
Yeah.
And I think that could be an asset class, that a really nicely designed, medium density, well located near a light rail, whatever. That's going to be a fascinating class of property.
Yeah.
So I think that's a standout. But yeah, I'm not too sure if I could back Sydney over the long term for that investment grade. Well, there is nothing. There is no houses in that 750K bracket to back.
And I think that in of itself is a really good point. I always say that if you're an investor, I mean, I'm talking about the average investor here, just because you're living in Sydney, doesn't mean you have to buy an investment property in Sydney and outlay $1 million or $1.5 million. Surprising, that's still the concept of a lot of people, because they see it as a world city. That's where all the jobs are. It's not necessarily the case that you have to do that. And just on that point, I completely agree with you on the townhouse point. Places like Oxenford in the Gold Coast, houses have gone up so much. The rent market is completely booming, and you can still buy a villa. I mean, I'm not talking something with a complex with a pool or a tennis court that's expensive to maintain, but just one, villa in a complex of 4 or 8.
Yeah.
It's under $500,000. I mean, that will not be the case. Let's see if I'm right, but that's not going to be the case in 5 years' time. Let me tell you that right now.
Look, the reason why it jumps at me and I'm nodding is because I do an analysis, and I've done a map called cash flow analysis, cash flow map. And what I do is I take properties that are recently sold, and I pair it to a rental estimate, and then I let the highest yields rise to the top. And what are they? By and large, everything you just said. Most of them around Tweed Heads all the way through that pocket, just to the Brisbane East, but mainly around the Tweed. That's where they jump. So that's where the yields are. But I remember the first place that my wife and I bought was a beautiful Art Deco unit in Coogee, and the ground floor was a garden unit. So still in the same strata block, 7 units. The bottom one, no views, but it had an enclosed little garden area. And that was definitely worth about 150K more than the rest of them, because it would be very suitable to a young family. And so, it was very much a townhouse in a block of units.
And downsizes, to that same point that you were making before. If someone has a lot of cash in Sydney, downsizing to a lifestyle location like the Gold Coast, there's a lot going for it. Anyway, I don't want to spruik Gold Coast here. Let's talk about Perth real quick, because East Coast, if you're looking for a metropolitan area, it kind of breaks the rule that you just said, under 750K for a freestanding house. But in Perth, you can get, very good quality suburbs. I mean, we're not talking central CBD type stuff, but very good quality areas for under 500,000, under 600,000, that are yielding between 5 and 6%. I mean, no one's got a crystal ball, but what's the data telling you about the time horizon over the next 1, 2, 3 years? How are those types of suburbs going to going to perform? And I'm kind of positioning this question in the context of, you know, before APRA made those changes in 2016, 2017, everyone sort of thought that Brisbane would be the next big city to boom because Melbourne, Sydney had already boomed.
Mm.
And because of these macro national changes, it almost kind of took the gloss away from Brisbane just as it was trying to kind of, get started. And, it was unfortunate to say the least. Perth has already done really well. People don't realize that. It's actually done really well and it's continuing to do well. But do you think that these interest rate changes, which, they are affecting everywhere in Australia, but people don't really have an affordability problem in Perth? Do you think that's going to take the gloss out of Perth, or is the data suggesting that there are many areas, freestanding houses that will continue to do really well in the West Coast?
Look, Perth is such a patchwork quilt. It's so many, so South Perth comes up as some negative sentiment in some of my data and analysis. So, there's some issues there. A couple of other things. So I've got a set of models and data that I've used, and no model is perfect. And the more you leave it through time, the more the model has to change to stay relevant. And the approach that I've taken knocks Perth out. All right. It continually is biased against Perth based on a couple of key metrics I was using, one of those being pipeline supply. But that's changing. Now, what I mean by that is, current level inventory and forecast inventory, which also takes into account building approvals over the last, year or two. And a lot of these markets in Perth have suffered from slightly higher inventory level, but also pipeline supply and some forecast there. So for me, Perth hasn't really jumped out to date in comparison to some of the other options, specifically Adelaide, Brisbane. Yeah. But things have changed a lot. Adelaide's becoming very, very tight, and it's gone, well. So is Brisbane. So I think that wave shifted across, and a lot of the online forums have doubled down on Perth. Perth seems to be the hot spot that people talk about. But it still doesn't change the data and the models that I use. Not that, and I could be wrong.
Yeah.
Everyone could shift over there and drive the demand up. It's just the method and the approach I've used has accounted for supply and demand factors that have penalised Perth in comparison to Adelaide and Brisbane. So look, there are some markets. I'm just having a quick look at some of the ones that still haven't peaked. Perth Southwest features very, very strongly in markets that have not peaked yet. So I'm looking at Melville, Gosnells, and Kalamunda as the SA3s there, and I've got Wanneroo. So pretty overrepresented in my list of SA3 markets that have yet to peak or maybe peaked in August. So, so that now they haven't gone to, a lot of them haven't really gone to dizzy heights, but they've done well and they're still doing well.
They've done well. They're still doing well. And look, I couldn't agree more with that comment around that building approvals pipeline. There is a lot far north and far south as well. I guess time will tell how much of that building approvals will translate into real buildings. Building costs have gone up so much, and sentiment often becomes a self-fulfilling prophecy. I think I did a video, I think it was 2 years ago, and I was looking at the building approvals pipeline in Brisbane and just the state of the economy, and I was thinking, how can Brisbane do that well over the next 2 years? And then COVID happened, and then all the stimulus happened, and then obviously I was proven completely incorrect. So it's hard to predict these things, but in Perth, it is very patchy. It's not a case of Brisbane a year ago where you put a blindfold on and you'll make money. That's definitely not the case.
Exactly. But one thing, one conversation I had with somebody who was looking at an owner-occupied, I said, go and look at Perth. Because, if you can work from home, if you can be a digital nomad, if you can, if you can get a job that sustains you living in Perth, wow, value for money, good quality city, great weather, great housing, and compared to the to what we've got on the East Coast here, it leaves us for dead.
Yeah. And we were talking about this before as well, Kent. I think that one of the enemies of future price growth is past price growth. Oftentimes people see that something has grown in the past, therefore it's a good bet, right? Like it's a surety that this is an outperforming area for the future. It's often sometimes the opposite. And so that's why I feel that, I don't know what your thoughts are, but I feel that we can be quietly confident about Perth because it just really hasn't done anything. Now, that doesn't mean that all of a sudden, because it's done nothing, it will do something. But statistically, regression to the mean, there's more upside than downside.
Yeah, I have started to look at a long-term growth, 5 years up to 2019 before the crazy boom. So that gives me a bit of a benchmark to say, when the dust settles, will it look like that 5-year growth period to 2019? And that's the best I've got. There might be a better approach, but if somebody's got a better approach, I want to know.
Fair enough. Oh, okay. Well, last question I wanted to ask you because there's literally thousands of people in my audience that are watching or listening that want to be like you, like that they and not from a weird way, but like from a data perspective, they want to understand that they want to make conclusions themselves, not just listen to PK and Kent, be like, I want to just follow what they're saying. What are some key data metrics or some key calculations even that investors should have in their arsenal when figuring out where to invest for themselves, by themselves?
Yeah. Obviously, there's some big economic stuff that you've got to get comfortable with. And, as a general rule, does it have all those amenities and facilities and employment? Does it have a good spread of industry as well? You don't want to go into a one industry town. So they're the kind of the macro things, the airport, the hospital, schools, all that stuff. Once you've got that out of the way and you get down into the market itself, one of the standouts that the ABS offers is a socioeconomic index, and it's a score of 1 to 10, 10 being in the top 10% of social advantage, and 1 being in the lowest socioeconomic disadvantage. So that score is a pretty handy metric, and they offer that score right down to a very small neighborhood. But let's just say you want to use it for an area, use it for the suburb. So there's a suburb score. So I'd look at that. So you start to understand the socioeconomic variables of the area. Once you've got comfort there, some of the stuff at the suburb and market level, look at listings volumes. Are they going up or down? Let's bring it into context of now. If you're studying stuff now, are listings volumes going up? Are sales volumes going up with it, or stable or coming down? And if that ratio is getting out of kilter, you'll see something called inventory, which is the ratio of those two inventory levels building. So, for example, if you've got 10 listings and 5 sell per month, 10 divided by 5, 2 months of stock, that's pretty healthy. But if you suddenly have got 4 and 5 months of inventory and it's building and growing, generally we could say that's going to put some downward pressure on prices. So inventory analysis, looking at the movement of listings and then sales volumes, will give you a reasonable handle on it. If you're looking at it through the lens of an investor, you want to understand vacancy rates. I think, obviously, flipping back to the census information, how big is the rental market? Is it below 10% rental tenure, or is it above 50%? Below 10%, it's probably a little bit too small a market. Above 50%, it's going to have some volatility to it. A lot of those markets that were 50% plus leading into the COVID exodus of, the students especially going back home, a lot of those over 50% rental tenure markets suffered. So look at the volatility through time of their rents, and look at the volatility through time of vacancy rates. You'll probably see that a lot of the volatile markets have a very, very high rental tenure. So you're looking for that Goldilocks sweet spot of size of that rental market. Look at the short-term price trends, just so you get a bit of an idea. Is the market going down? If I'm going to buy somewhere, can I put a low ball offer in that might get accepted? So I think understand those trends, and if inventory is building at the same time as prices coming down, you've probably got some negotiation power.
Yeah.
A big one that a lot of people forget, they zoom in on the median and that's scary. That's got a lot of risk to it. So the median at a suburb level is a little bit risky. It's just the middle value. Well, if the only stuff that's been listed for the last few months have been expensive properties, well, the median is going to be high. So look at the price distribution. I put that on the suburb trends map. That's free. Look at the segments. Look at how the percentage of sales in each price bracket. And if that looks a little bit like a bell-shaped curve, then yeah, the median's going to be pretty reliable. But if you're in a beachside suburb or some of these more diverse suburbs, you might find 2 or 3 submarkets, 2 or 3 very distinct price distributions in one suburb. So understand the spread of values. And if you're buying a property in the top end, be very careful. You don't want to buy something that's going to break suburb records for price and then think you could spend 300K renovating it and sell it. You don't want to be inventing your price.
Yeah. No, well said. And that median concept, I think people don't understand. So if that kind of went over your head, for everyone who's watching, just rewind and listen to that again. We recently bought a house for living in a place called Sorrento in the Gold Coast, and since we bought it, the price has for the median has come down in that area. But if we were to sell that house right now, we would get what we paid for it. It's because there are other dwelling types, other houses that are, not on the river or not on the canal and other areas of that suburb. Those are the ones that are selling, and they're inferior, quote unquote. So you have to be very, very careful around that. No, well said. And the other thing that I want to highlight, and something that you've said, Kent, is looking at trends, regardless of whichever metric that we're looking at. Don't just take a snapshot, August or September 2022. You have to look at month on month or quarter on quarter or year on year to paint a picture of what's going on in your head. And if you do want to paint a picture of that, I mean, there's so many data sources and some are reliable, some not so reliable, but do check out Kent's website, suburbtrends.com. Kent, was there anything sort of that, you're in the market, you're on LinkedIn, you're probably interacting with investors and things like that. Given the sentiment, the sort of media rhetoric at the moment, is there any advice that you want to give to folks at the moment?
Yeah, look, there's a couple of things that excite me about the market. There's some spots that are becoming rather affordable. I think the biggie that everyone's going to drill down on now is picking the bottom. So I would argue that just get your mind around that, because the media will start to double down on that. That'll be the big thing. And I think don't forget the fundamentals, that you've got areas that are always going to be solid. You've got areas getting some significant spend in terms of infrastructure. So just look at those long-term things first, and then look for the bargains that might turn up within it. And yes, you might want to wait till the bottom. Picking the bottom is going to be hard, though. So you wait too long. I do think, to your point, I think there's going to be a long flat period. So I don't think we're going to rush back into a boom again anytime soon.
No, I couldn't agree with that more as well. And at the same time, picking the bottom is almost like a fool's game, because it's, folks like Kent, yourself, it's hard. Like you yourself will say it's hard. It's near impossible, regardless of whatever asset type or, stocks, whatever, like anything, it's hard to pick the bottom. And so my mantra, I don't know if you agree, Kent, is there's always markets within markets. There are areas that right now in Australia that are still growing. Could they finish their growth phase next month or in 6 months or in 12 months? It's hard to tell, but they're still growing. And there'll be times, or there'll be markets that are bottoming out while others are still falling. So it's markets within markets. It's not so much when to invest, but if you're comfortable investing, it's more about where and how to invest. Do you agree with that?
I do. I think that one of the things that's standout is the cash flows are so good that even if you bought a few percent above the bottom, is it something you could live with? That's only a question you can answer individually. But, the house I'm in now, that was originally an investment property. I probably paid about 3 or 4% too much, but over time, it didn't really matter. And it was a tough purchase because we couldn't find exactly the property we wanted. So that's probably a positive right now, is suddenly as choice gets a little bit better, you don't have to buy the main street. You don't have to buy the sub. You buy high quality location. And I think knowing the top streets, that's my big thing now. My big focus is analyzing and knowing what the top streets are in a suburb. And as listings volumes increase, obviously the choice and the opportunity to buy in the top streets starts to come around. So I think that's a big focus.
Yeah, I did notice that publication from you. Yeah, it's not just about suburb selection, intra-suburb selection, which are the right pockets, worst pockets. All of that is gleaned or can be concluded through data and then verified by just a few phone calls. But it's very important. Maybe that's for another time, Kent. But
Yes, yeah.
thank you so much. I really appreciate it. Thanks for your time. I know you're a busy man, and guys. I really do urge you. I have no business affiliation with Kent, but I sometimes go on suburbtrends.com myself just to check it out. It's there as a resource. Use it or don't use it, but it's there for you guys. Thanks so much, Kent.
Great. Thank you, PK.